interwebs right now. If you can hear me, you're in our the Selfwealth YouTube channel, or if you can find me on Facebook, isn't that what they used to say? Find us on Facebook. If you're on Twitter, say g'day. Hopefully I can see all of you commenting and just saying g'day and good evening. Welcome to Wednesday. Plant One, I can see you've already commented through YouTube, so that's fantastic. G'day, mate. It's always a pleasure to have you back on the live stream. So tonight we're doing our usual thing, except we're broadcasting to a few more places. So it's a bit exciting for us in the back end here. Pima, Pocket Full of Shell, welcome back. So tonight we're going to be talking about the 10 best performing companies from the United States or the US stock markets. However, we're going to look at a few of those names in particular, and we're going to try and recap what we did last week, which is where we looked at the top 10 Aussie stocks. There were names in there like Pro Medicus, Objective Corp. I'll get them up in just a second. And we reflected on what made them so successful. And tonight we're doing exactly the same thing, but with the United States. So we're looking at all the companies in the United States. I've scraped a big database. I've looked at the best performing companies. And then we're going to run them through a bit of a, I guess you could call it a checklist. It's a very simple checklist. G'day, Benny. Welcome, Ray. Ray, as a recent winner of our Value Investor Program giveaway, welcome back. So, as always, you know how I like to start the show. I like to start the show with a bit of a joke. So let's bring up tonight's joke. And this one is probably one you have to see, but I'm going to try and bring it out anyway. So this is the joke. Okay, what do you call it when James Bond, that's James Bond, crashes the US stock market? I'll give you a second to think about that. And while I do that, I might share my screen. I'll get my screen ready, locked and loaded. G'day, Martin. That's it. Rob's joining us from Facebook, and he's also inside YouTube. So if you see comments from me or from Rob, we'll be in either of those channels. So what do you call it when James Bond crashes the US stock market? Now, I can tell you it's called a SPY fall, an SPY fall. SPY, you probably know what I'm talking about. SPY, the S&P 500 ETF or trust, is one of the most popular in the world. It's a SPY fall, so that's what we call it. That's my joke. I feel like if Jeremy was here, he'd be saying that's a terrible joke, but I feel like it was okay. Although he does normally give me a bit of confidence. So tonight we're going to be talking about not just jokes. We're going to be talking about the most traded shares inside Selfwealth. We're going to be talking about all of these top performing companies. We're going to be talking about the most sold, most bought. And then we're going to add Salesforce, which is the company we didn't get to last week, to the Low Tofu portfolio. If you're new here and you're thinking, what on earth is Low Tofu? It's one of the virtual portfolios that we have here inside Selfwealth that we're building every week. We build 2 every week. We're allocating a fictional $1,000 every week to the portfolio. So there's 2 in total. And we are adding new names in the form of ETFs or in terms of companies. We're adding both of those to the portfolio. So Rob said on Selfwealth, I think, Rob, you're getting ahead of yourself here. So I'm loving the dual streamings because now I can complain about Owen's jokes across 2 platforms. Okay, I see how it is. Okay, so let's get on to the top 5 most bought and most sold. Just remember that any of the companies or any of the investing questions that I answer tonight, if you're in YouTube or on Facebook, any of those things that I answer is strictly limited to general financial advice only. If you want personal financial advice, you have to see a financial planner. A financial planner can take into account all your needs, goals, and objectives. I cannot because we are online with hopefully hundreds of other investors all at the same time. So I simply do not have that information. Okay, so let's talk about the top 5 most bought shares inside Selfwealth. Remember, if you are new here, what you can do is you can guess the name of the most bought share inside Selfwealth and the most sold every week. And if you get both of them correct, you'll get a free Value Investor Program course. This is a course that I created on our Rask Education website. And it's usually $499, but we give them away to any investor who can guess the most bought and most sold on the night. All you've got to do is send us an email and proof of your social profile. So whether you're on YouTube or whether you're on Twitter or wherever you are, you got to send us proof and you can get the free Value Investor program. Okay, so the way it works is I go in reverse order from 5 through to 1 most bought, and then 5 through to 1 most sold. So get your guesses in, please, in the YouTube live chat or on Facebook or wherever you're watching us from. And I'm going to start at number 5. And you need to guess, before I get to number, what the most bought, and then we'll do it for the most sold share is. So in number 5, we have Core Lithium. Core Lithium is the kind of junior lithium play here in Australia. We can see it's got a market cap of $2.1 billion and, according to Selfwealth data here, not a lick of revenue. So we talked about this last week in our 10 top performing companies. You may remember this chart here. We talked about the 10 best performing companies as at that date over 10 years. And a few of them were lithium. You see Core Lithium down the bottom here. It's gained 1,600% over 10 years. Piedmont Lithium. We also had Liontown Resources up in here as well. Now, what we discovered when we dug a little bit deeper is that some of these companies just do not yet have that revenue and cash flow, which we so dearly want. So please, I think this is, as we discovered last week, a bit of a caution to the wind here, because if a company cannot grow its financials to match its share price performance, it's almost like a timing game. You're almost waiting for the company to fall off. Now, many companies, maybe Core Lithium is in this boat, is an early stage, are early stage businesses. And so what that means is sometimes you don't get that revenue until the company has matured. So keep that in mind. So Rob's just dropped something into the chat saying, winners, be sure to email us at marketing@selfwealth.com.au. So I can see Danica said most bought SYA. Sayona Mining is the one, Danica, that you've guessed, which is unfortunately not in the list. Vinay says Lake Resources. Well, we'll have to find out. What's number 4 on our list? Number 4. And I did make a boo-boo here, guys. I did include ETFs in this list. However, I will tell you that the number 1 ETF from the weeks gone by is not the ETF that is number 1 traded this week, nor is it an ETF at all. It is a company that is at number 1 on both the sold and bought list. So keep that in mind. Okay, so at number 4, we've got the VGS ETF, the MSCI International Shares ETF from Vanguard. Super popular ETF. We know for international diversification. We haven't actually covered it in a standalone show here on Selfwealth Live, but we know it's well diversified, low cost, as you would expect from Vanguard. Long-term focused is what people are investing in VGS for. Likewise, in at number 3, we have VDHG, Vanguard Diversified High Growth Index ETF. This is an ETF. Now, the way I can describe this, even though it's not technically correct, it's an ETF of other ETF. It's actually an ETF of managed funds, but what it actually does is you invest and you get exposure to many different ETFs inside it. Another way to think about it is like if you get Hello Fresh meal deliveries and you get them in the box, it's like a box, and then inside that box are more boxes. So that's basically what we're getting in terms of all the ingredients, just like shares. Okay, in at number 2, and this is where I said normally Vanguard's VAS, Australian Shares Index ETF, is number 1. It is the biggest ETF in Australia by a hop, skip, and a jump. It is investing in the ASX 300. So when you invest in VA, you get exposure to BHP, CSL, Telstra, all of the biggest companies, and you also get franking credits as they pass through the ETF. So just like a normal diversified fund, it is super popular. Okay, so we do have number 1 left. So what is going to be number 1? Let's have a quick glance back at the submissions. So Ray's guessed PLS, Linda's guessed Lake most sold, BHP most bought. Jason said, hey guys and girls, Rob and Owen. G'day, Jason, pleasure. Abdul has come through from Facebook and said, is the lithium stocks done for now, especially those on the speculative side? Yeah, Abdul, I would almost agree with you there. I would say that many of the lithium stocks that we have come across, not all of them, but many of them that are early stage may be at a point where we need to be a bit more realistic in terms of valuations. We saw, I think it was Goldman Sachs come out last week, Abdul, and said that they believe because of some changes in Argentina and around the world, they think that lithium prices may actually have peaked for now. So that's something you can actually look that up there, Abdul. I'd point you to the Goldman Sachs research. You could probably find it online. So in at number 1, Ray, you've got it again. This is Pilbara Minerals. This business, as we've spoken about numerous times, and we should probably try and reach out to someone from the company because they've come up so often, is further along the journey. It is not early stage, even though it is mining resources. It is not a business that is still really speculative, earning revenue. It is growing its fundamental performance. You can see it right here in front of you inside Selfwealth. So we can see cash from operating activities has recently turned positive. So this is a measure of basically the cash that's coming in and out of the business. We can see that it's finally turned positive. So well done, Ray. Another one for you. Now you've just got to get one more correct and you are back on the list again. So, okay. Peter Rasmussen coming through from YouTube as well. Is the qual ETF still a good thing? Loving the lives, Selfwealth. Well, thanks, Peter. Okay, so qual ETF, before I get to the most sold list, the qual ETF is one of, full disclosure, I do own this ETF. I do actually quite like this ETF. What we've seen in recent times, we've seen a bit of downwards pressure on a lot of the companies. This is an ETF that invests in 300 companies. So I'll show you qual ETF. It's from Van Eck. We've spoken about it before on the show. So Peter, I'll maybe refer you back a few weeks or months in the Selfwealth Live archives, and we can see it. Basically, it takes the global market and then ranks companies based on low leverage, returns on equity, which is like a quality factor, a measure of the financial quality of a company, and low levels of debt, low levels of debt, return on equity, high return on equity, and I think that the last one is earnings consistency. So basically looking at a company and seeing, is it consistent in terms of its earnings? So yeah, I mean, this is an ETF. It's diversified. It gives you exposure to high quality companies, and we can see some of them here. Many of these are tech names or big global like technology platforms, which means that when the tech sector falls off, you're probably going to feel that a bit because there's going to be a lot of investments in that sector. So I guess that makes sense. Peter, I still own the ETF. So now we're going to go and we're going to jump back in and we're going to go with the top 5 most sold. As always, 5 through to 1, most sold. Now, what I see every week when Rob sends this data through is I see that almost every week without fail, there are never ETFs in the most sold list. So what does that tell me? Remember when we look back through the Selfwealth community and we can look for members, remember just if we take some random members, let's say one that's got 8 holdings here, Mong, I think this was from last week as well, and we look at the holdings, a lot of these top performing members, even though this one is quite concentrated, I think that was Roger's point last week, even though they only have 8 positions, many of the top performing members inside Selfwealth are ETF investors. Now, these numbers are not, it's always a point in time. It's not always perfect. But I think what we've seen and what I'm seeing more and more is more of the Selfwealth community are continuing to invest in ETFs as a way to get diversification and to get exposure to markets. And what that does is when we look at the top lists, we see investors continually trick money into the market. So, okay, let's get through to it. Let's get this top 5 most sold done. So in at number 5, we have none other than Fortescue Metals Group. We did a session on this not too long ago. Fortescue pays a massive dividend, or at least it has historically, when prices of iron ore have held up, because that is its number one commodity. It does make a little bit of money outside of iron ore. This is the dividends down the bottom here. It does make a little bit of money outside of iron ore through its like infrastructure and what have you, but for the most part, it is an iron ore play. So this business can have that massive seasonality depending on iron ore prices, depending on a few other things. But for the most part, Twiggy Forrest, who's the billionaire now and founder of the business, has done a great job, along with Elizabeth Gaines and others who have managed Nev Power, who have managed that business before this. So I think really interesting business. We've talked about it before. Its transition to green hydrogen is really interesting too. So now, if we go back to number 4 on our list, number 4 most sold, Bubs. This is a company that for many a time, I actually did quite like this business. And what I found out was kind of the hard way was that as it pushed into China with infant formula and goat's milk went awry, it kind of turned on a dime. So if we look at the financials really quickly, we can see revenue going up, which is always fantastic. We can drop down and see gross profit a bit more modest. So when I see this, when I see revenue going up, but gross profit not going up nearly as fast, that's a sign that the business has low profit margins or low gross profit margins, and it needs a lot of inputs into its business to make revenue. Now, what was really interesting, and I'll come back to me here if I can, what was really interesting about Bubs for me is, I've got a glass here actually. One thing that I know analysts did is they looked at the infant formula, say if it was in Chemist Warehouse or whatever, and they looked at the infant formula, and then on the bottom of the infant formula, there would be a best before date or a used by date on the bottom of the infant formula. And what some analysts would do was that they would go through and they would look at all the tins of infant formula to determine across the different brands that were available, which ones have expiry coming up now. Because if there's a tin sitting on the shelf and it has expiry in the near future, it means it hasn't sold for a while. Whereas those that have, a lot of product velocity, meaning a lot of demand, they're going to be turning over, and their best before dates will still be months out into the future. And so I did that with Bubs, and for a while, I could see that the business was doing quite well in terms of getting product out the door. They were signing deals with Woolworths and a few other big distribution outlets. They signed one with Chemist Warehouse, but they never really reached the kind of ascent that A2 Milk did. And they kind of got caught up in that same sell-off for a while. Christy Carr, who is the founder of the business, was around during the IPO too, and kind of stepped, as far as I could tell, stepped away a bit from the business. And they signed, I think it was Jen Hawkins as like a brand ambassador. Anyway, the reason why the business has popped recently, I could keep going on, is, and you can see it down the bottom right-hand corner here, if we go back to the last 6 months, the business has actually just got approval to trade in the United States, I believe. So if we go to news and announcements, let's go to market sensitive. So we filter out all of the kind of newsy stuff. And here we can see US operations, fly formula, White House roundtable, US FDA discretion to import Bubs infant formula. So this was a big announcement for the business. The US Food and Drug Administration announces it will exercise discretion for the immediate import, sale, and distribution of all 6 Bubs infant formula products. So that's good news for the business. The US is potentially a massive market for them. Ray, you've said, speaking of milk, is there any hope now for A2 now that the US is having a milk shortage? Yeah, well, that's really interesting, Ray. Well, to be honest with you, I'd like to think so for A2 Milk's sake, because they do have operations in the United States. This is A2 Milk. Now, I think I've mentioned this a couple of times on the show. I love A2 Milk. I've got it in my fridge. I buy it every week. But it's not the type of business that I've wanted to invest in for quite some time, at least since the trade war with China and Australia, because it relied on that grey market, that suitcase trade, to get its product into China. And then obviously all the issues happened, and then we had COVID, so it restricted travel of people that were going in that Daigou channel. And so for me, personally, I'd rather probably invest elsewhere at this time, but that's just me. Okay, so now so Roger, you just said Bubs got a one-off order from the US to fill a supply chain void because of a food poisoning scare with major US suppliers. Is it a long play or is it a one-off order? Interesting, Roger. I did not know that. So I haven't kept up with Bubs since I sold it, at least not as well as you have. So that's really interesting. Stevie, you said A2 Milk getting some life back due to Bubs surge with the US formula shortage. I think the Daigou channel is closed off due to COVID and tensions/politics. Yeah, agreed there. Okay, so number 3, that was number 4. We spent a bit of time on that. In at number 3, we've got Lake Resources. So Lake Resources was a guess. At the most sold, I believe. Lake Resources is an Australia-based company which engaged in the exploration and development of lithium brine projects in Argentina. And so we can see here, there was like I said, there was an announcement out of I believe it was the Argentine government, who came out and was concerned about pricing of lithium. So this is probably a reaction to that for investors. In at number 2, another company that we mentioned before, which is Core Lithium. Core Lithium, as we know, early stage. And finally, in at number 1, we have Pilbara Minerals. So Pilbara Minerals takes the spot as the most bought and the most sold. We scroll down the page on the overview, we'll see what people are thinking. So 61% of people are buying. So when I get this data through, it does show me that there were a lot more investors buying Pilbara Minerals shares than selling it. And we can see the reason that people are selling, taking profits. A lot of people selected other, aligning with a target portfolio. 61% of people who are buying says stock is undervalued, company's earnings potential looks good. By the way, I often get asked, where does Selfwealth get this data? This data actually comes through from a Selfwealth users voluntarily when they pick a share to buy or sell. They can select an option from a drop down just like this. So Pima, you said, looks like Selfwealth members are only trading resources stocks. And I think that's natural. Pima, when we do this most bought and sold list, we often see, right, that it's more the tech or the resources stocks, the really like in vogue type companies that tend to make this list. And it makes sense too, right? Because traders, as opposed to long, are looking for that type of activity. So I guess that makes sense, right? Whereas when if we include ETFs, Pima, we see a lot more of that dollar cost averaging long-term investing going on. I hope that makes sense. Jeremy has arrived late to the game this evening. Hey, Owen and Rob. Jeremy, you missed my joke. I thought you would have been. I thought you would have been good for that one. Stevie, you said, I sold out of Pilbara Minerals 6 months ago and regretted it. Have a chance to buy back in, but there are so many good deals available in the entire market. I would agree. Genevieve, you said, I was close. PLS for most bought, PLS a second choice for most sold. Very, very close indeed, Genevieve. So, Rob, maybe we can have a look. Did anyone actually get it both correct? Ray guessed most sold PLS. What else did you guess as the most bought? Jeremy, oh no, what was it? I need a pick-me-up laugh. Well, Jeremy, I tell you what, right at the end of the show, I'll share with you my joke. It wasn't that good, so I will tell you that in advance. But hopefully it picks you up anyway. So, okay, so now we're going to move on to a different section of the show. Right now we're going to talk about the 10 most bought and sorry, not the 10 most bought, the 10 best performing stocks over the ultra long term. And by ultra long term, I mean 10 years. We could go back further if we wanted to. And I'll just bring up my data on the main screen now. This is data that I pulled out of obviously a database. And you can see how I've looked at all the different companies in here. Actually, we might zoom in a bit just to make it a bit easier to see. Now, this list here is from the Cap IQ database, which is a database of financial like metrics across companies. And what we can see here, and I think this first one we'll find is an anomaly. It was a bit of a data error. But what we can see here are a list of companies that have performed extremely well over the last 10 years. Now, what I've also done, because it was quite abstract, just to look at the share price performance, I've actually thrown in a couple of metrics here. And the reason that I put these in, right, is because we're not interested so much in identifying what has done well in the past, but what could do well in the future. So I'm trying to find different ways to slice and dice the data so we can get some insights. Now, if we quickly recap what we went over last week, just as a kind of FYI to those who are new tonight. So here we can see the list of the top 10 from Australia. And remember last week, and you can go back, it's one of our most popular episodes we've done to date. We talked about how Pro Medicus, Altium, Objective Corp, even Nearmap to an extent, Polynovo, although it is a bit smaller, and Kit McGrath, which is a very small company. These companies actually have done extremely well, not just from a share price perspective, but also from a fundamental company performance. So we're seeing more sales, more profit, so on and so forth. The three that I've circled there are the three that I own, just for disclosure. So the reason that we brought this up is because when we spoke a few weeks back, we talked about how there was this study done by Boston Consulting Group that showed statistically which companies on the stock exchange do the best over 10 years, and how can we kind of monitor and understand the performance or the drivers of their stock price performance. And according to their research, what we saw play out was revenue growth. The growth in sales of the business was actually the thing that explain, statistically speaking, the most of the return. Now, in the short term, obviously, we've got different things. So we've got things like the profit margins and so on and so forth. So when we look at a company, what would that look like in practice? For example, when we look at our most bought and sold list, and Pilbara Minerals was there. Now, if we were looking at the reasons that investors were buying, if investors were buying for reasons, let's say, that were like taking a chance, I think there's got a good tip, taking a chance down the bottom here. What I would find, if that was number one on my list, I would actually be quite concerned, because as a long-term investor myself, I'm not looking for something that's going to be, a punt. I'm looking for companies that are actually going to grow for a very long period of time. Now, if we jump back into our list, we don't need to be financial, analysts or wizards to know some of these companies and why they've done well. I've actually highlighted in fluoro here some of the companies that have done extremely well, which you will probably know. So we can just talk about some of these quickly and then we'll dive into them. So obviously Tesla is a company that we've covered in our live sessions recently. We've got NVIDIA, which is a company that does the graphics cards for a lot of like PCs and for different technology around the world, including data centers. Further down the list, we can see Netflix, and even though it has taken a bath recently, you've probably seen that in the news, it is still up 2,100% over the past 10 years. Now, if we go down even further, Axon Enterprise is probably not a name that's immediately familiar to you, but this is actually the company, and you'll see over here on this, it's actually quite a bit smaller. It's got net debt of $437 million. It's actually about an $8 billion company, so it's quite small by US standards. It is the company that does tasers, non-lethal weapons for police forces and security agencies around the world. So non-lethal weaponry. That's that company. You've probably heard of tasers before. AMD is another, it's like a play on computing. So like NVIDIA, AMD is the chip that might go in your PC or your laptop or something like that. Obviously, the semiconductor industry, many different themes here at play. AMD is a very, interesting company for technologists. If we come further down the list, we can see another name that will be very familiar to you, which is Adobe. Many of you will use Adobe Acrobat. Many of you will know Photoshop. Many of these different brands, Premiere, Illustrator for those creatives in the group. This is the company that controls all of that. Further down, this is a company that I did not expect to see in the top 100 best performing US companies, but this is fascinating. This company, Avis Budget Group. You probably know this company because you probably hired a car from them in the past. Avis Budget Group, and never mind my spelling. You probably know this company because you think, oh, well, I see that at the airport. I see it wherever. I didn't know that Avis and Budget were owned by the same company, but here you go, they are. So here's a company that does something that is not technology, that is not like really kind of glamorous or sexy, say like Netflix or Tesla, but it's done so well over a very, very long period of time. And yet it does something that, we could all get a car and drive for Uber or just hire out a car or something. So you'd have to wonder what its competitive advantage is. But it's done so well over a long period of time. This one right here, you may be familiar with, is MSCI or MSCI. MSCI is one of the biggest companies in the world at creating the indices or the index, which say an ETF might follow, or I think one of them before we saw with VGS. So if I go Vanguard's ETF, the super popular ETF, this MSCI index is MSCI is the index provider, and then Vanguard follows MSCI's index. So the way MSCI would make money is it would make money by licensing that index. So that's how that business operates. Domino's Pizza. Now, we know Domino's Pizza in Australia is a really good performing company, a really well-performing company. If we go to DMP is Domino's Pizza here in Australia. This is the company that owns the franchise for Australia, I think it's Japan, and some parts of Europe. So this is a company under Don Meij, who's the CEO, has been extremely well-performing over the long run. Don't let this, sell down for you here. It was, what was it, at $9 a share 10 years ago? It peaked recently at 160. It's still at $63. So it is a really interesting business in itself. But the US company is kind of like the master owner of the brand worldwide. Now, if we drop down, we're almost at the bottom of this list, and some final companies that I'll throw your way. Amazon.com, so up 1,075%, one of the biggest companies in the world. Mercado Libre, which, if I can be so crude, I would say it is the Amazon of Latin America. So it does basically everything that Amazon does in terms of marketplaces, but it also it's got a business called Mercado Pago, which is a business that's more like Square in that, or more like PayPal in that you can get cash out, you can use, you can tap and go, and you can do all those things. There's like mini terminals for sellers and store owners. And what's really interesting about this is a lot of people think that Latin America, would be pretty well penetrated in terms of banking. It's actually not. So it actually does extremely well at kind of leapfrogging communities in Latin America, where they go straight from cash straight to paying with their mobile phone. Whereas, say for example, in Australia, we went from cash to swiping or inserting our card to then paying with our mobile phone. In certain parts of the world, like developing countries, companies are leapfrogging that middle part, which is the card, and they're going straight to digital. Finally, we can see Take-Two Interactive. If you're a player of video games like NBA 2K, this is the one that you'll know really well. We can see Electronic Arts, which is another gaming company. And if we scroll right down the bottom, we can see Microsoft, which owns not just Microsoft, but also owns LinkedIn, the Azure cloud computing platform, and so on and so forth. Roger, you've said El Salvador went straight to Bitcoin. Yeah, well, and Argentina went straight to the US dollars. So, yeah, it's interesting. Jeremy, you asked a question. So, hey, Owen, I'm all for investing in companies that will continue to grow based on their fundamentals assessment. But how do we know if you are late to the game? I feel like Xero, Apple, Alphabet, Tesla are expensive per share. So I've been looking at quote unquote cheaper companies, yet tend to do that larger growth in the future. Still a lot to learn. So, you know what, Jeremy, when I interview people for the Australian Investors podcast, and I interview these, really successful investors, what they keep telling me, and this is not, you can go back and listen to it. It's not just me making it up. What they keep telling me is obviously the number one piece of advice is start early. They say compounding is the most powerful thing you can do. So start now. But the other thing that they say, and this is quite common when I ask them the question about their lessons learned, is they say oftentimes that they should have watered their flowers and not their weeds. So what I mean by that is, now if we go back to, I'm gonna zoom in on your question, but I'm gonna start a bit higher first, Jeremy, if that's okay. If we go back to this here, this was just a very crude chart that I drew for you guys. And what it shows is, according to a study done by Bessembinder, and that's spelt like this, Bessembinder. So this is a study that looked at the long-term performance of the stock market to determine how many companies produce good results, basically. So what he did is he compared stocks against the performance of bonds, or just treasury bills, which are kind of like really short-term bonds. And what he found, and there's this graphic here, and I can maybe put this back in the chat. And what he found was that, I'll just block that 1 second. What he found was that in certain markets, there are moments where only 1% to 4% of companies actually do better than the average of treasury bonds. So let me just break that down. Basically, he said, if you're investing in the stock market, only 1% to 4% of all of the companies create all of the wealth. Now, if you think about that for a second, it looks like this graphically. In some markets, like the United States, that's only 1 in, say, 25. If you're in developing markets, in some developing markets, there's only one company out of, say, 70 Now, what this is telling me as an investor is when you find companies that do really well, you don't want to be quick to disregard them because there's a chance that they could keep doing really well. And the amount of effort you have to go through to find some of these companies is very, 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 very strenuous. So you don't want to have to keep doing it again and again and again. Now, to your point around, I guess, whether companies can keep growing or not, right? Here's a good example in Apple, a company that I knew really well. When I bought Apple shares for my personal portfolio, it was quite a few years ago now, but I think then I recommended it to our members I could be wrong, around about 2018. Now, at the time, Apple I think it was a $1 trillion company, or it was just about to hit $1 trillion. And people were saying, Apple is almost $1 trillion. It is too expensive. It cannot keep going higher. And then it got to 2 trillion, and people were saying it's almost 2 trillion. It can't keep going higher. And then it got to 3 trillion, and they're saying the same thing, right? Now, what that actually overlooks, so it's 2.4 US trillion. Now, what I've found is that a lot of people who say that miss the mark in terms of, well, it's not about how big the company is, it's about how big the opportunity is and whether or not they can capture that. So in the case of Xero, which is a company we've spoken a lot about recently, it's another company I own. Sorry to be talking my book so often, but it's a good example. In my defense, you did bring it up. So in the case of Xero, it does a software, accounting software. Now with Xero, it has, I think, 3 million subscribers across Australia, New Zealand, the UK, about 300,000 in North America. This is just off the top of my head. Now, so there's got about 3 million so far, right? But if we consider that every business basically in the developed world needs accounting software, and the only two major players are Intuit, which is also doing really well, and well, then we can think, okay, how big is this market and how quickly can it capture some of that? So for Xero, if we think it's got 3 million subscribers now you can't just go wishful thinking and think, oh, there's 40 million businesses in the United States, therefore it could grow to 40 million. That's not the way it works in reality. However, what we know is that in Canada alone, there are 4 million businesses that are going to need to make their accounting digital. Just like what happened in Australia, New Zealand, and now in the UK, it's currently underway. It's called Making Tax Digital, or MTD. So Xero has found that, hey, we might not be Intuit in the United States, but there might be 4 million subscribers up for grabs in Canada. So then we think, okay, so we know how big the company is, right? Then we've got to work out, well, how many of those subscribers will they get? How much money can they make for those subscribers, and how long can they keep them? And that's basically what we do as analysts. We say the market is so big. I'll bring this back to me. We say the market is this big, and we know that they might capture this many customers, and they might make this much money from them. And so that's where our fundamental analysis comes in. We don't just look at like stock prices or company size. We try and get a basis for justifying how big these companies can grow. And this is actually, so last point on this, Jeremy, because I know it's a good question. It's on a lot of people's minds. What you're actually alluding to is actually probably a harder decision, which is when to sell. Now, when to sell is one of those decisions when you're like, okay, it's done so well. Now what happens? I'm going to give you an example. The best example, and it is actually tying into our list right here, the best example is Netflix. Now, I would love to know if anyone in the chat is willing to volunteer this information. Out of all the big streaming services globally, so let's start, we've got Netflix, we've got Amazon Prime, we've got Apple TV, we've got Hulu, we've got Disney. In Australia, we've got Stan, we've got Panorama TV, in the Sky in the UK, heaps of different ones. There's even ESPN in the US for people who watch sports and whatever. Of all of those services, could you please put in the chat which streaming service you use the most? I'll put mine in. I'll see if you can see it. Mine is Netflix. Now, Netflix is a business that has grown really, really well. And we did a whole session on this. So, Jason, you've said Netflix and Prime. Katie, you've said Netflix. Paul, Netflix. Martin, you said Apple. Interesting. JJ's Prime. Plant One, KO. Yeah, I love KO. Errol, Prime. Paul, and Netflix. Danica, I don't use any. Danica, okay, we should have said YouTube for you. Michael Arts, ABC. ABC is fantastic. There's also an app on that. iView. I like it. Prime from HBP, Binge and Netflix, Benny, HBO and YouTube, TV, cool. Matthew, Disney, KO. Rob's just come in, Netflix, then Stan, then Disney. He's doing all three. If I put my streaming service in the chat, I might be banned, says Stevie. Okay, good idea. Netflix, Monica, then Binge, then Prime. So Rob's obviously got them all. SBS demand for Jordan, Netflix and Prime because it's free with Amazon Prime. Yeah, that's a good point. Let's just promote Prime streaming because it is free if you've got that account. iView, says Peter. Oh, interesting. Pocket full of shell. You said, I have them all, but I'm dropping Netflix this month. So, Roger, you've said Walt Disney, multiple successful income streams. Yes, indeed. So, my point here is that when a company loses its competitive advantage is when you should consider selling. Now, there are multiple ways to do that, but we were going to do in a session recently, and I've still got it on my list to do in the next month, is when to sell. And this is probably a harder question than when to buy because we all get excited when to buy. But if we look on the screen in front of us here, we can see that Netflix has basically fallen off a cliff. Now, there are many reasons for this, but if I bring up Netflix in the news, just randomly plug it into Google, people were basically fretting that Netflix is going to lose on account of Disney and all of these other players entering the market, the subscribers falling off the hill. And also we saw that Netflix came out and said, yeah, we're not going to grow as fast. And hey, also heaps of our subscribers aren't actually paying for our service. Now, this is where it comes back to, if you're an investor in one of these fast-growing companies, you have to have a thesis or a reason for investing in that company. If your reason for investing in Netflix was, I believe user numbers are going to go up, I believe they're going to be able to charge more than $14 a month, which, by the way, has happened, you will then be, okay, thinking, okay, immediately when they stop adding users or when they stop being able to charge as much, that's when I'll start to think that the business isn't performing. And we see Matthews here. He said for Prime, it's $58 a year. So Versace says Prime was increased and dropped. Now, this is a point here to you guys, is that we're seeing a company that has gone from the sweet spot of growth and it's probably come back a bit. At the same time, Netflix costs are going up. By the way, the new Stranger Things is out. It's a bit scary, but I like it. And every time I watch that, it's set in the 80s and it's got lots of graphics. And I think to myself, how much would this thing have cost to have made? And that's what we're seeing play out with Netflix. So I hope all of this makes sense. Versace, you said 125 in the US. Is that, Versace, is that for Prime, is it? 125. Wow. Okay, it's a lot more expensive than here in Australia. If only you could get the Australian version and use the US equivalent. So, yeah. So at the end of the day, Jeremy, this is an extended answer to your question, but what you can see is that basically when the company's competitive advantage, you don't want to be there when the competitive advantage falls away. Now with Apple, right, everyone thought that Apple, when I bought it, when I invested in it, was dying. Well, you can't spend more than $2,500 on an Apple iPhone. What, everyone's going crazy. And they were probably right. Like Apple's pricing on iPhone has probably reached its peak. However, then they brought out I've got one here. They brought out the AirPods, which you can see on my head. They brought out, I think it was a $30 cleaning cloth and sold 1 million of them. They've now started with Apple TV. They've got buy now, pay later, they announced this week. And so they've rolled out all of these, what we call services. It's just software revenue. And now that business has got a new lease of life and it's extending its competitive advantage. I actually think I have a chart on this in here. And naturally, I do not, and it's not available to me right now. Okay, wonderful. There goes that idea. So I'm going to get to Salesforce in just a few minutes, but many of these companies, yes, to your point before, Jeremy, have done extraordinarily well in the past. But the thing is, a lot of them still have further to go in terms of what addressable market they have. It's up to you to determine when you go in and learn about these companies. And by the way, I was going to show you how to learn about these companies. You can just go to the 10K or the annual report for any of these companies. And at the very start, every company in the United States is required to issue all of the information about the business in plain English. So what do they do? How do they do it? Who are the competitors? What are the chief risks? So on and so forth. So for example, if we go to Netflix's one and we go risk factors, so they have to outlay some of these risk factors. And in here, I'm certain, I read it before, that we will find all of the different, basically, competitors that they've identified. Now I'm going to see if I can find some of these. Let's have a look. Let's see if I got Amazon here written somewhere. There we go. We rely on Amazon Web Services, so that's a risk. While the retail side of Amazon competes with us, we do not believe that Amazon will use the AWS operation against us. Okay, what about YouTube? To see if they mention YouTube as competitor. What about Hulu? They don't mention that in here. So if we went through and found them all, I'm sure Netflix would outline, and they do them in their letters too, all of the key risks associated with their business. All of them do it, and I think that's a great way to start your research. Now, in the case of a company like Tesla, which we've spoken about before, we have what we call optionality. And I'm not going to spend too long on this, guys, because we've talked about Tesla before. But in the case of Tesla, like Apple, what we can see is the business is not just a car company anymore. The Cybertruck's coming out. They've got more affordable models. They've got the Powerwall. They've got solar. They've got all of these different things that they do off the back of having really good battery technology and electric vehicles. So this is what we call optionality, the ability of a business to grow outside of its current growth trajectory. And that's really, really interesting. Okay, so I've kind of waffled on about this for long enough, but here we go. We've got a question from MD Kabir. You've said, do you know of any book or course how to determine competitive advantage of a business? There are so many, MD. One of them that I will throw your way, which is a really easy read, is The Guerrilla Game. Investing in high technology, this one right here. That's a fantastic and easy read. But by far, the most important and kind of the leading in this were the Michael Porter books. So Michael Porter, Competitive Strategy. I talk about all of this in the Value Investor program that I run. But in this book, he talks about basically how companies find competitive advantages. So, okay, Jeremy, you said, am I one of the reasons we go over each week? No, it's fantastic. Pocket full of shell, and you weren't here to support Owen with his opening joke. That's right, Jeremy, you weren't. So I'll have to get that back to you in just a sec. So Versace, new subscriber, fantastic. Welcome. Don't forget to hit subscribe if you're watching us on YouTube, or if you're on Facebook or Twitter, hit follow. We'd be forever grateful, Rob and I. Stevie, you said Squid Game is also pretty good if you want to watch a Netflix TV series on survival. Yeah, that's a good one. Okay, so now I've got to quickly. There are a couple more things that I just want to touch on. So we've got all the companies here. What I did was to make sense of. Remember this chart down here, the one how I said revenue growth explains a lot of the performance of these companies. I actually looked at the revenue growth of these companies over 10 years. Now, the revenue growth is CAGR, meaning that it's compound annual growth rate. So it's like growth on growth. Now, what I'm going to do is I'm actually going to go down here and I'm going to get the average of the 50 best performing US companies, just according to this list. I'm going to go like this. And I'm going to show you the average is 22%, right? Now, if we take the average of the other companies in the list, wrong column, equals average. If we take the average of the other companies in the list, we can see that to be in the top 50 performers on the US stock market over the past 10 years, your revenue should have gone up on average by at least 22% per year for 10 years in a row. Now, for the next 50, it was only 14%. Now, I'm just bringing this up as a way to illustrate the academic study or the industry study that we saw, which is that if your company is growing continuously for a very long period of time, that's a pretty good predictor of company performance, obviously, right? The other thing that I looked at was how much debt do the companies have? Net debt is in red. That means they've got more debt than cash. And the other thing that I looked at, which is something that a lot of people probably wouldn't think of, is the growth in the number of shares. Now, I'm going to be really quick here, but and I'll bring the video quickly back to me. In order for a company's stock price to continuously go up, there are a few things that have to happen. One is obviously they have to perform well, and investors have to invest in the company and bid it up. So they have to pay a higher price. Now, if a company has two sources of capital, it can use a bank loan or go to the bond market and get debt into its business to fund its operations. Or it can issue shares, it can sell more shares to investors or to employees for performance rewards and all that sort of stuff. And it's got two sources of capital. Now, if it issues debt, issuing debt doesn't actually impact individual shareholders unless the company falls into financial difficulty, in which case it has to pay back the bond and the debt owners first. It has to pay the bank back first, just like you would with a mortgage. But when it issues shares and when it's constantly selling more and more of its shares to new investors, it's actually diluting you. And so that puts more pressure because there are more shares on the market. There have to be more investors willing to buy the shares. But if the company's issuing too many, the share price won't continue to go up. So I bring this up because a lot of people think when they look at this column here, now the first one is an anomaly, so don't pay too much attention to that. The second one is a very small company. But if we go from here down, we can see that even Tesla has had to issue shares to grow its business. We can see the same with Daku New Energy Corp. I do not know this business. And we can see down the list that many of these companies really haven't, if I just get the average down here, we can see the average is only a 3% increase in shares every year. But we can see that some companies do a really, really poor job of this. They constantly just binge on shares to fund their business. So yeah, I think at the end of the day, we want companies that have a good, strong debt profile. So they don't have lots of debt early in their growth trajectory, and they also aren't issuing many, many shares. Ray said, "How do I get a copy of that list? Maybe I can share this with you. I'll drop it in the comments after this." Okay. And Jeremy, you said, "Sounds like a lot of zip. Way too much share dilution." Yeah, so that's it. Share dilution. I should have said that from the beginning. Zipco is the Australian buy now, pay later company. And you can see that if we go into financials and we go down inside Selfwealth to diluted weighted average shares. That's this bit right here. So we can see the number of shares. Basically what Zip was doing was it's selling shares to new investors and then using that money to buy other companies and make its revenue go up. That only lasts for so long. So I was going to go through a bit of a scoring methodology here for you again. Remember that before Christmas, so that's going back a little while now, we did a checklist session. If you want to go back before Christmas in the Selfwealth Live archives, on the Selfwealth Live YouTube channel, you will find the checklist session and where we created a checklist to run companies through. But I thought maybe a worthwhile exercise would have been just doing a very simple checklist to see how each of these companies perform. And we know that revenue growth for many of these companies has been pretty promising. So, for example, if we look at the revenue growth of Tesla, it's 74% per year. That's huge. NVIDIA, it was 16%. So just as a way of example, we would give, say, out of 5, we'd give Tesla a 5. And for NVIDIA, it might be like a 2. And then at the end of the day, we can add up all the scores from all the companies. So if we looked at net debt for these two companies, net debt, we've got a lot of net debt for both companies. So let's just say, but they could probably handle it. That's the question. That's the thing. So 2 and 2. And at the end of the day, we could add up all of these scores and we could do our own checklist. But I won't go through that tonight. Rob's just dropped it in the chat. It's the checklist investing episode we did before Christmas. Okay, so I want to get to one thing because I didn't get to it last week, and I'm definitely going to get to it tonight, which is Salesforce. Salesforce is the company we are adding to the Low Tofu virtual portfolio. You will remember all of the companies that we've got here that we've added to the list. So over time, we're adding a company every week. This week, we're just adding one because last week we just added ProMedicus. We can see all the companies here. Rob and I will share a chart with you this with you on social media this week. Hashtag Selfwealth Live on social media, on Twitter, Facebook, wherever you get your social media. But we can see all the different companies, ETFs we've added in the past. So what does Salesforce do? Salesforce is a fantastic business. It's actually it's the innovator of the software as a service, or SaaS model. In around about 1999, Mark Benioff, who is the co-CEO of the business today, he started Salesforce after leaving Oracle being the big database and software business. And the difference between Salesforce and basically every other type of software at the time was that Salesforce software you could access through a browser. So just like this, I'm using my Google Chrome. I could click try for free, and I could log in. I could create an account even if I don't have one, and then I'd be up and running in minutes and paying for the right. I would be paying Salesforce for that. I'd be paying $25 or maybe even $1,250. Now, over time, what Salesforce has done is it's got bigger and bigger and bigger, and it's got more software engineers, and it's issued more different types of software. So for example, if we go here, we can see all of the different core verticals. They've made acquisitions over time. So Slack is this messaging software we use at Rask. You can see the analytics, which is Tableau, which does data analytics. You can see MuleSoft down the bottom here, which does integrations. And you can see all of these different pieces of software that come together. Now, I have actually, somewhere in my notes here, you can see this is Salesforce's business, and it's all looking wonderful. You can see this is from the most recent quarterly report. It's revenue up 24%. This thing here, you might not have seen this before unless you invest in the United States. Versace said SaaS is becoming a disgust around the US. Yes, it is globally too, I would say, Versace. It is SaaS is no longer cool. It's no longer sassy. It's kind of turned a bit of an eye, hasn't it? Mike, you said I work for one of Salesforce's competitors in Australia, at least. Mike, what you don't have to tell us the competitor. Maybe just tell us what you think of Salesforce. Is it a worthy adversary? Is it a strong competitor? Tell us what you think. Stevie, you said, I love Slack. Yeah, so I think I mentioned this last week on the show, the Selfwealth Live, that Salesforce bought Slack. And the way they bought it was through Slack itself. The management teams of Slack and the management teams of Salesforce were communicating inside Slack to make the acquisition, which I think is kind of cool. B. Caddis, you said, does it have a strong ecosystem? Why use Slack when you can use Teams? Mike, and you followed up. Thank you very much. You've said Salesforce is one of the most mature CRMs out there. It is indeed. It is very mature. As you know, Mike, it is one of those things where, because it is a SaaS business and it's cloud-based, it can actually innovate, and it can be agile as a software company and continue to innovate and bring new products to market very quickly. So that's what we've seen here. So we've seen the company make acquisitions in the past, like Tableau and MuleSoft, but also Slack here. And we can see the core sales CRM. This is the business here. And by the way, what's a CRM? It stands for Customer Relationship Management. It's the software that helps you manage your customers, whether you're doing sales, whether you're servicing existing customers, whether you're just helping them connect and speak, or whether you're doing marketing, or whether you're helping them take payments, or down the back here, whether you're helping them do data analytics. So you can see, exceeded $1 billion in revenue. So that is a tremendous feat for the business. And if we drop right down the bottom, we can see here the growth of each of these platforms over time has been exceptional. All of the businesses are growing. Now, there are many risks to this business. One of the risks is that it continues to make acquisitions and they're not really, they don't really fulfill on them. It's not able to turn all of that revenue into cash flow or profits. So there are a few risks, but for the most part, Salesforce is what I would say a very wide moat business. It's very competitively advantaged. I would encourage you to go and check out their report, and I'll just put that in the chat. Annual report. Now, the annual report actually talks about one thing, which I'll just finally call out here, which is that the company actually commits, it actually commits 1% of its equity, 1% of its profit, 1% of its employees' time, and 1% of their product to serve communities. So that's actually a really interesting thing in terms of how the business, I guess, gives back to the communities around it. B. Caddis, you said Teams is crushing Slack in terms of users. Yeah, B. Caddis, you are correct. Teams is absolutely crushing Slack, but Teams has a native integration. Obviously, it's a Microsoft backbone. And you could say the same about Google Workforce, to be honest, or Workplace, sorry. So Google's tools, I think from memory, I could be wrong. This is live, mind you, so I could be wrong. B. Caddis, I think Google was able to get to 300 million users in its workplace within like a couple of years. And the reason it was able to do that is it turned everyone that used Gmail into a Microsoft Drive, a Google Drive user, and then turned them into a Google Docs user, and then turned them into all of that sort of stuff. And so, yes, it does have an incumbency, but Teams isn't the only one. I think the new kid in town is actually Apple. I think Apple's going to make a big foray into the business world as well, like Microsoft. So yes, Salesforce is not the only one. If it started to lose customers or customers that it wasn't winning, then I would be concerned. But it's been, yeah, it's a big thing. So Versace, good point here. Google Classroom is used in the majority of children schools and universities. Yeah, and that's, Versace, you probably know this too, that a lot of these big tech companies want to get their software in the hands of kids and students because then that's what they know. That's what they've been trained on, right? So, B. Caddis, yeah, ecosystem is everything. I agree, B. Caddis. What I would say though is that none of the competitors like Microsoft or Apple or Google have made sales enablement their priority. So that's probably where they're a bit too big to be interested in that marketplace right now. Yeah. Okay. So Freudian slip indeed, Jeremy. Okay. So I like the business. As we've acknowledged, there are some risks around it. It keeps compounding pretty well. If it lost users, if it didn't keep winning, then you have to revisit your investment thesis. So as always, I end the show with a bit of a quote, and I'll bring that up here. Where is my quote? Here we go. So my quote for this week is a pretty simple one, and it is from Winston Churchill, who says, "A pessimist sees the difficulty in every opportunity. An optimist sees the opportunity in every difficulty." So what on earth does that mean, and what does it have to do with investing? Here in Australia, Versace, you might not know this, here in Australia, interest rates went up 0.5% today, the biggest move in a long while. In the United States, we have inflation going wild, as we do in the UK and elsewhere in the world. Now, the thing to remember is that oftentimes the media, at least in finance and investing, is very negative. There's very rarely something positive to say. Now, that's not just necessarily unique to finance, I guess. But oftentimes what you find is that there's this great quote that gets brought up from Warren Buffett, which is, "Be greedy when others are fearful and fearful when others are greedy." At the moment, around the world, there seems to be a lot of uncertainty. But if you're a long-term investor, and I mean that by 5, 10, or 20 years out into the future, there's really no cause for alarm, because if you're investing for that long, the world is still just as optimistic. It should be as optimistic to you as it was a year ago, because you know what? We're still innovating. We're still coming out with breakthroughs, new technologies. Industries are evolving and getting better. We're solving some of the world's biggest problems. Yes, there are some real bad things going on in the world. There always are, like in parts of Europe right now. There are some really unfortunate things happening. But at the end of the day, as an investor, one of the easiest things to do is to build that core of your portfolio. Sure, you can add high growth companies like those we talked to tonight, but you can build that core of your portfolio and slowly dollar cost average. Just keep plugging away. And over the ultra long term, the stock market, I believe, this is my belief, this is my opinion, tends to work because it is the place that is the center for value creation. It's where investors, people like us, can take part in other people solving problems. And that value creation is ultimately what we make our money from. So every time Salesforce helps a team get more out of their data or out of their workflow, they're solving a problem, they're creating value, and others are going to pay for that. Interesting point on this. Salesforce has actually created its own artificial intelligence engine. And I believe, I could be mistaken about the exact number, but I think every day it makes 160 billion predictions. 160 billion predictions. So I can see some quotes in here. Jeremy, here's the joke. It wasn't very good, so keep this in mind. But I've rehearsed it, like you said. Here's the joke. What do you call it when James Bond crashes the US stock market? The answer, a spy fall. That's my joke. So not that great tonight. Don't forget, over on Selfwealth, we have a lot of things going on before the end of the year. The annual subscription for Selfwealth Premium is up for grabs until the end of the month for only $240, I believe. That gets you access to a heap of great things. It's usually $382. So $240, you get all of like the bells and whistles, which you saw on my screen, but you also get some trades in that. So it's pretty good. Don't forget too, there's Big Swinging Stocks. It's a podcast from Selfwealth. It's available in your podcast player. Morningstar was one of the recent guests on the show. Big Swinging Stocks is the one. Umbrella Lemming, thanks for joining us tonight. Thank you for joining in. If you have any requests, guys, remember you can find us, #SelfWealthLive. I'm available on Twitter at Owen Rask. That's at Owen, R-A-S-K. We do have a bunch of things that we've got on our list, including guests coming up and the reasons to sell shares. If you want us to look at any companies, let us know. Rob says there's a new episode of Big Swinging Stocks coming out tomorrow. So that'll be in your podcast player tomorrow. So we have it on good authority from Rob. So thank you everyone for joining us tonight. It's been my absolute pleasure. It was good fun talking about the best performing companies. Stay safe out there. Remember to be optimistic. We'll be here next week at the same time. That's Wednesday, 6 p.m. Australian Eastern Time for those of you that are elsewhere. I don't know what the time would be in the US, Versace, but we'll be here. So if you're around, be sure to join us. Thank you everyone for joining us tonight on behalf of Rob and I. Thanks. Onwards and upwards.